Welcome back to Yahoo Finance's special presentation of how 2020 changed the world. Jared Blikre is here with the Wi-Fi Interactive Board. And Jared, what a ride it's been for investors over the past several months, especially since hitting those March lows.
Yeah, and let's take a look at the year in perspective here. What I have is a quarter-to-date chart first of the S&P 500, and it gives us kind of a more granular look of the recent price action. And this is what we've seen. November was a huge month of rotation. We'll talk about that. We got those 3 consecutive Mondays of incredible vaccine news, and that fueled a lot of the gains and the rotation there. And then in the month of December, it's simply been melt up. But yeah, let's take a look at what happened in late February and early March. Here's the year to date in the S&P 500. And this was, in fact, the quickest bear market in history. We dropped 35% off of those February highs, and it was very quick. And one of the things we've been talking about, I've been kind of harping on, is the transformation in the markets where we see lower liquidity for a variety of reasons. Some of that has to do with the transformation from the old open outcry method into electronic trading. That only progresses. We now have clients, we now have brokerage houses selling order flow, so there's less transparency on it. And overall, the algorithms, the technology is just so quick, everything gets priced in very quickly. So at these lows, which we know in hindsight was an extremely good buying point, it seemed like the bottom was going to fall out. And it seemed a lot to me like late 2008, early 2009. But there are some interesting parallels to that period, 2009 in particular, because in March of that year, similar to March of this year, we got huge announcements by the Federal Reserve that they were going to dramatically increase their balance sheet. Now, in 2009, almost nobody knew what that meant. Now we know what QE is, and it's been off to the races. Globally, something like $8 trillion in central bank stimulus, along with $12 trillion in fiscal stimulus. And all of that adds up. And we're seeing that reflected in the markets, despite the fact that we are in a lockdown right now, which is just incredible to think about. A lot of places in the second wave of the COVID pandemic, we have markets, the U.S. markets at least, at record highs. And we still see volatility a bit elevated here.
Jared, how much of the market gain that we've experienced this year is true fundamental growth versus stimulus and CARES Act and a big boost from Congress and the Fed?
Well, that's an incredibly loaded question, and I hope to be able to answer it as well as possible. A lot of it has to do with the interest rate situation. Interest rates were low coming into this. Now, we had the Federal Reserve raise rates 4 times in 2018. They had to kind of take their foot off the brake there, but that was already in progress. They were already expanding their balance sheet with the repos before we got into the COVID crisis. So, you go back 10 years, we've only had the 10-year maybe at 3% at its highest. It's nearly 1% now. Benchmark rate of the Fed, those short-term rates, those have been low. So I think a lot of that has to do with the strength that we've seen in some of those growth names, not just the pandemic ones, but Tesla, for instance, and then the big FANG stocks. Those were attracting a lot of money because interest rates were low. So that's been a big part of it. But there's also been some incredible disruptions in technology. And you go back to Tesla. Well, they're disrupting transportation here. So I think a lot of these moves would have happened eventually. But because of the interest rate situation, because of the pulled forward demand of a lot of innovation that the response to COVID necessitated, I think that going forward, we're going to see more of the same. And I think it's going to persist probably longer than a lot of people think of. Even if we do get a lot of rotation, we're not going to see those big FANG names fall out of favor anytime soon, as long as we have those low rates.
Hey, Jared, how about this rotation that we've seen, the change in leadership? I mean, people are rotating out of some of those growth names that were really sky high, the outperformers of 2020, and into some of those beaten down, underperforming value names. In order for that rotation to stick, what are investors looking to see? What needs to happen?
Well, first of all, the vaccine schedule needs to stay on track. Now, we've had a lot of announcements. Almost all of them have been positive. We only had one negative announcement. I think it was Pfizer news a week or two ago, and the Dow sold off maybe 200 points intraday because it was older news. But going forward, we're going to have to marshal forces on a scale that we haven't done in a long time to get vaccine distributed. And any hiccups in that schedule, in those distribution plans is probably going to weigh on the market. If it's a small one, a little hiccup, probably be a buying opportunity. If it's a major one, let's say, and let's try and anticipate some black swan event, if a vaccine had to be pulled from the market, very, very unlikely. But if it had to, I think that would cause a massive disruption in the market. And there'd be a big sell-off in the indices and a massive rotation underneath the hood. We also have the potential for a blue wave in January. It's small, but we got those Georgia runoffs. That could easily change the calculus. I think we'd see a sell-off, maybe 5–10% in the majors, but that's mainly to do with the reorientation, the rotation that would have to take place. So let's take a look at the Wi-Fi Interactive here. We can take a look at the sector action over the last quarter. And you can see the standout right away is XLE. That's the energy ETF. Well, that's up 34.5%. Just incredible gains here for some of these value and cyclical sectors.
Jared Blikre, thank you very much.